Welcome to the Vaughan Nelson podcast. Today is the second quarter 2026 Vaughan Nelson Global SMid recap. And with me today is portfolio manager Jim Eisenman. Welcome, Jim.
Thanks, Dan.
All right, Jim. Taking a look at the portfolio for the quarter, it underperformed its benchmark. Can you walk us through some of the drivers of that relative underperformance and potentially highlight a few of the top contributors and detractors?
Sure. Stock selection contributed positively during the quarter, but our asset allocation detracted from relative performance. And it was really our underweight position in Taiwan that served as the largest headwind. Overall, our names performed really well through earnings season, but this was definitely a quarter where what we didn't own hurt us relative to the benchmark. During the quarter, market returns remained concentrated in a relatively narrow group of companies tied to AI, data center, infrastructure, and related capital spending. Companies with exposure to these end markets continued to outperform the broad market. Our two largest contributors to performance during the quarter were Sanmina Corporation and Element Solutions. Both of these names benefited from their exposure to AI driven markets. Sanmina provides outsourced design and manufacturing services for complex electronic systems, including AI infrastructure. Management's focus on investing in higher growth, higher margin end markets, combined with strong customer demand, drove an excellent earnings report, and the company was re-rated accordingly. Element Solutions is a specialty materials company whose products are used in semiconductor manufacturing, printed circuit boards, and other advanced applications. As semiconductor complexity continues to increase, the amount of specialty chemistry required per device also rises. This drove strong earnings results and an increase in guidance during the quarter, and the stock reflected.
Okay, thanks, Jim. And how about detractors? Any common themes behind their underperformance?
Our two largest detractors during the quarter were B3 in Brazil and Spire in the US. B3 is Brazil's leading stock exchange and financial market infrastructure provider. It operates the country's equities, derivatives, fixed income, foreign exchange, and security settlement platforms. Spire is a regulated utility in the US. It also has natural gas storage pipeline, midstream assets that support stable rate based earnings growth. Both companies delivered solid first quarter operating results. However, investor enthusiasm remained heavily concentrated in AI related companies, leading many stable, high quality compounders to lag the market despite good fundamentals and execution. In B3's case, the stock also faced additional pressure from investor uncertainty surrounding Brazil's upcoming presidential election.
Turning to portfolio turnover, looked like it moderated a bit during the second quarter compared to the first, but you continue to add some new positions and exited a handful as well. Any common themes there and behind those portfolio changes?
So, throughout the first half of 2026, we've generally been net sellers of tech and data center related holdings, primarily based on valuations. Late in the quarter, we took advantage of the brief pullback in tech stocks to initiate some new positions where attractive valuations were supported by strong underlying fundamentals. We also added select companies with exposure to emerging market consumers, where we continue to see compelling long term secular growth opportunities. Across these investments, the common thread is businesses with durable competitive advantages, capital light or scale driven business models, and management teams making disciplined investments. We reduced or exited positions where expected returns no longer met our hurdle rates, competitive dynamics had deteriorated, or where the valuations had become difficult to justify.
And then let's talk a little bit about the portfolio positioning. How's the portfolio position today, and what's driving those decisions?
From a sector perspective, we're overweight industrials, consumer discretionary, materials, financials, and utilities, while underweight all other sectors. Our positioning continues to reflect where we see the most attractive asymmetric risk reward opportunities driven by company specific fundamentals and, importantly, capital allocation behavior. We believe a meaningful divergence is emerging across our investment universe. Companies that continue to invest thoughtfully for long term value creation are distinguishing themselves from the businesses focused primarily on managing near term pressures. We continue to use periods of market volatility to selectively initiate new positions or add to existing holdings where we believe the long term upside meaningfully outweighs the near term risks.
All right, well, great. Well, thanks, Jim. With that, let's look over at the returns. In the second quarter of 2026, the Vaughan Nelson Global SMid strategy returned 11.74% gross, 11.5% net. and the MSCI ACWI SMid Cap Index returned 13.3%, which brings the year-to-date return for the Vaughan Nelson Global SMid strategy to 14.21% gross, 13.71% net, and the MSCI ACWI SMid Cap Index is at 13.56%. Over the past 1 year, 28.84% for gross for the Vaughan Nelson Global SMid strategy, 27.7% net, and 23.24% for the MSCI ACWI SMid Cap Index. Over the past 3 years, Vaughan Nelson Global SMid strategy has returned 17.26% gross, 16.22% net, and that's versus the MSCI ACWI SMid Cap Index at 16.59%. For the past 5 years, Vaughan Nelson Global SMid strategy has returned 9.01% gross, 8.04% net, and that's against the MSCI ACWI SMid at 7.22%. And last since inception, the Vaughan Nelson Global SMid strategy has returned 16.14% gross, 15.11% net, and 13.2% for the MSCI ACWI SMid Cap Index. With that, Jim, that's a wrap on the second quarter. So thank you for coming in, and we'll have you back here soon.
Sounds good.
The views, information, and/or opinions expressed during this podcast are solely those of the individuals involved and do not necessarily represent those of Vaughan Nelson and its employees. Vaughan Nelson does not verify and assumes no responsibility for the accuracy of any of the information contained in the podcast. The primary purpose of the information, opinions, and thoughts presented in this podcast is to educate and inform. This podcast, or any podcast in the series, does not constitute professional investment advice or services, and any reliance on the information provided is done at your own risk. Past performance is not an indication of future performance. By accessing this podcast, you acknowledge that the entire contents of this podcast are the property of Vaughan Nelson or used by Vaughan Nelson with permission and are protected under U.S. copyright and trademark laws. Securities discussed within this podcast may be held in the Vaughan Nelson strategies.